Awesome. Well, first things first, Austin, it's an absolute pleasure to obviously be here, and thank you so much for having me. And guys, it's obviously awesome to be able to kind of sit and speak with you this evening, my time, wherever you guys are based in the world, morning, afternoon, whatever it might be. But we really want to try and cover a topic this evening that quite frankly isn't spoken about much online, right? Because the long and short of it is when you're talking about portfolio management and longer term stuff that isn't really as active, it's not sexy, right? It's not exciting, it's not fun, right? So when you see guys on Twitter, Instagram, whatever your social media platform preference is, the fun, exciting stuff is, we traded the open, we banked 1 hour or something like that, within the first 5, 10 minutes of the open. Now that is an unbelievable skill to have, but it is not the only thing. As Austin said there in the introduction, it is not the only thing when it comes to markets, or it's not the only thing when it comes to building wealth, because it's all well and good being able to do that and having that skill set. But now every time you're not in a trade, you're not making money. Your money's not working for you, right? Plus, as Austin said there, you don't want to be the 40, 50, 60-year-old day trader, doing that, having to do that forever to get your money working for you. What you want to be able to do is have a skill set such as the day trading that Austin, James, and Tom and everybody teaches you, be able to generate an income basically, or be able to generate some profits there, whether you work alongside it or whatever, but you're profitable in that space, and then be able to now distribute those earnings that you've had and distribute those profits that you've had in the day trading arena and be able to now get your money working for you in other ways. Now, when it might be if you take a break from day trading because you're away with a family, or you've got something going on with work or other projects and things that you want to work on, you now have a portfolio that is working for you that doesn't require a huge amount of time and attention, and it's still there. Ideally, obviously, in market conditions that suit and, providing you set it up correctly, is still there generating you money, right? And that's what we want to go through this evening, talking about how you can do that and what you need to focus on. Okay, so that's what I want to focus on now. I'm going to give you my current view on markets as well, by the way, and how I'm personally structuring my portfolios at the moment. But I want to just go through a little bit of an introduction, just in case you haven't come across myself before. It might be the first time you're sort of hearing me speak. You may not have seen the podcast with Austin, or may not have come across me on Twitter or whatever. So a very, very quick, brief introduction on me and my background. So obviously, my name is Ben Spam. I'm a full-time trader and investor, and I've got over 12 years experience now in the financial markets. I know what you're thinking. I don't look a day over 21, but I've been in the markets now since I was about 20. I started first paying attention. I was in the fitness industry previously, started getting an interest when I was looking at other ways to make money. And then I've been very, very fortunate that I've been able to get exposure to the professional side of the industry without going through the more textbook routes, if you will. So a lot of people, when they get into the professional side, they go through the route of they get a grad scheme or something like that at an investment bank, at a university or whatever it might be. Have that. So I went from being a personal trainer into actually becoming account manager at a small London-based fund called Zeus Capital Wealth. Okay, so my role as an account manager basically was to be the middleman between the investors and the trading desk. So I was literally on a daily basis working alongside the traders there, and they were trading UK-based equities and currency markets. That was their predominant focus there as a desk. So for around about 18 months, nearly 2 years, I was there every single day with these traders, and it just caught my attention. I was just wanting to learn and learn and learn. I had notebook upon notebook of, all sorts of stuff that I was kind of going through. And of course, I made a whole bunch of mistakes and stuff like that, the same as everybody does. But I was obviously immersed in an environment where I was able to then sort of have a professional trader as my soundboard, right? To be able to talk to, ask questions to, and stuff like that. Now, when I left the fund, I actually went over to the Institute of Trading and Portfolio Management, that's headed up by a former Goldman Sachs and JP Morgan trader. And I've also then been at another couple of trading education businesses since that have had guys that have got long careers within the industry. So I've been kind of on both the professional and retail side in a slightly less conventional way than normal, but I've been incredibly lucky along the way that I've had outstanding mentors that have literally been at the pinnacle of the industry that have been able to teach me these skill sets that I've got now today. And this is why, I really enjoy being able to now kind of almost, without sounding cheesy, give back in the sense of, now pass that on. Because if I'd have never had those mentors and people that are willing to do that for me, I wouldn't be where I am. So now I really enjoy that part. And I think, as Austin and the guys will probably tell you, it helps us keep sharp as well. When we're going through and teaching and coaching and stuff like that, it keeps us on top of our game, on top of our journaling, on top of everything that we do as traders and investors to make sure we're always sort of performing at our best, basically. Okay. So let me break down a little bit my sort of investing and trading process because, of course, it's a little bit different when you're day trading and when you're building a portfolio. Okay, so when you're day trading, it's much more technically driven because, of course, the fundamentals and the macro environment, they don't really make any difference to where SPX might go over the next 10 minutes, right? It makes no difference whatsoever. Now, you might still use macros and fundamentals to give you a directional preference, and then your process might be to only day trade in line with that, for example. I know some people that do that, but there's still going to be a lot more technicals involved than, say, when you're portfolio managing. Okay, and this is the key difference and where a lot of people struggle. There's a different process. All right, so to give you a bit of an overview, going from left to right here, my whole process starts with what is my macro and market view. So what is my macro view and what is my market outlook? So what do I mean by that? Well, what is my macroeconomic view? What do I think of the economy, basically? Do I think it's likely we're going to be in an expansive stage? Do I think it's likely we're going to be in a contractive stage? So I think it's going to be quite flat, right? Because as we're going to discuss in a minute, I'm going to show you some data. The economy and the stock market, they're very, very closely correlated and interlinked. So if I can get a gauge of where the economy is heading, that can give me an idea when the stock market and also other asset classes are potentially heading. So if I know that, well, now I know how aggressive or defensive I want my portfolio. Where do I want to focus, right? Do I want to be more in stocks, more in bonds, more in gold, etc.? I also want to have an idea of my general market outlook as well. Okay, again, we're going to get into this in a second, but sometimes the market outlook doesn't actually match up with the macro outlook, and you've got to be able to identify when those occasions could be, because that's now going to help you understand again how to manage your exposure to certain asset classes. Now, once I've got that view, I now basically know how I want to structure my portfolio and where I want to be focusing my attention. So then from there, I can move on to my fundamentals, right? This is if I'm building predominantly a stock portfolio, for example. So I would then do a quantitative screen. So I'm looking for companies based on some data that I'm able to screen out. So a simple example might be of a quantitative screen looking for a PE ratio below 30 or, earnings outlook that's positive, things like this, things that are able to help me whittle down from, say, like 10,000 publicly traded stocks in the US to maybe a shortened down list of, say, 50 or 60. And from that point, what I'm then able to do is do some qualitative research where I'm able to now pick out the companies that best suit and I think match up best the numbers that we're putting out, right? Just because a company is forecasting that it might grow by 10% next year, there may be a few warning signs and things like that within some earnings calls and stuff like this that make me go, you know what, I don't have confidence in that. So although that's the current projection, it's not really a company I want to be involved with, right? So we're able to then whittle down what we want to focus on. Now, from there, you can then bring in technicals, right? A lot of you guys are going to be very proficient in your technicals. You might have certain technical elements that you want to bring in. It's not really as essential when you're portfolio managing as opposed to day trading, but it's definitely something that you can help to bring in to help you time an idea. So again, a simple example of that might be, okay, I want to buy Microsoft stock, but then when you look at the technicals and you look at the chart, we might be in a short-term corrective downtrend. So what you're now going to wait for is some kind of break of a high, maybe a retest of a support level, something like that, to now give you a bit of confirmation in the price that it's now matching up with your fundamental view and that you now want to trade that. Same as you might have a view on bonds or gold or whatever. Same thing. Whatever your macro and fundamental view is, you can now take that idea and use the technicals to basically sort of select your timing. And of course, then, before you actually go and execute, there's the risk management element that comes into it. That comes into the portfolio structure, position sizing, things like that, which obviously all ties in and kind of wraps things up in a nice little bow. Now, that might sound a lot. If it's new to you, don't worry. We plan to answer some questions at the end of this, but of course, in the ideal world, we want to work out ways that we can start to do some more focused lessons on things like this. But the point being, I wanted to give you a bit of a general overview of my sort of total process from start to finish when it comes to generating and managing ideas. So what I want to talk about here is the economic effect on different asset classes, because the reality is we go through different economic conditions. And you've probably heard people say, money doesn't vanish, it simply changes hands. And it doesn't just kind of vanish from stocks. If stocks are having a bad time, it doesn't just vanish, right? Normally that is investors and traders coming out of stocks because they're looking to allocate capital elsewhere. And what you can basically do is you can take the economy and the different economic conditions that we get and essentially put it into four quadrants. Okay, so if we look at the growth element, well, we either get rising or falling growth, right? Either the economy is expanding or it's contracting. Then we have inflation that runs hand in hand with that. Is inflation rising or is it falling? So if we look at recently, we had 2022 where inflation was rising. We're now in a time period where inflation is falling, right? So we have different economic conditions that are typically present at any one time. Now, what you're going to find and why this is relevant and important is that different asset classes perform differently in different economic conditions. Okay, so if we look at the top left-hand quadrant there, we're in a rising growth environment. What performs best? Well, stocks do. And this is exactly why stocks have been the best performing asset class historically over the last 100 or so years, because if you look at the US economy, more often than not, it's been in a stage of expansion and growth. Hence the reason GDP in the US is obviously larger than any other country on earth. It's the biggest economy, etc. It's been in a stage of very strong, stable growth for a long period of time. And hence the US stock market has been the best performing market, right? But there has been obviously times when that hasn't been the case, where growth has been falling or we've had contractive stages. That's when something like bonds would perform well. If we have an inflationary environment like we had in 2022, what was the best performing asset class in 2022? Commodities, things like gold, stuff like that, right? That was your best performing asset class because that is an environment where that asset class performs best. If we have falling inflation, but we're not in a period of growth within the economy, we then typically get bonds start to perform better as well. I'm actually watching bonds very closely at the moment. And again, I'm going to kind of get into some idea generation and kind of what I'm looking for at the moment within my own portfolio. But I want you to kind of keep this in mind, right? At different stages, depending on how the economy is performing, different asset classes perform best. And this is very, very important if you're managing a longer term portfolio. Because if you're sitting there and creating a view for yourself, and let's imagine that view is like mine is at the moment, I believe, well, we do currently have inflation that is falling. We're not quite yet at the Fed's target rate, but it is falling. Okay. But we are technically, as things stand, in a growth environment, but there are some warning signs for that at the moment. And it is quite possible that we have some very slow growth, maybe even contractive economic conditions for a little while. And if that does end up being the case, we could find money flow a little bit out of stocks and bonds could be your place to go. Right. So if you're building a portfolio and you're kind of building a view of how things are and how you want your portfolio to be positioned over the next 3 to 6 months, for example, you want to factor this in. And basically what you're asking yourself is, how do I view the economy and what do I think is most likely to be happening in the economy? Now, it doesn't mean that you completely come out of one and go into another, right? You don't just completely run out of stocks and don't have any stocks and go all in on bonds. But it might be that you reduce some stock exposure, for example, and add a little bit of bond exposure. If we was going into an inflationary environment, you might reduce your stock and bond exposure and increase your commodity exposure, for example, right? You don't even have to hold all of these at any given time. You could be 100% stocks. But if you feel like we're not going to be an environment that is best suited for stocks, you might either start to hedge your stock portfolio, or you might at that point start to add in some other asset classes. Because in the ideal environment, I'd love to be 100% long US stocks during an economic growth period. That is going to give me the best return within my portfolio. But the reality is that's not always going to be the case. And we need to be aware of that as portfolio managers. You can also run portfolios where you hold all of these at the same time. And what you do is you balance them and how much weight and exposure you have. And this is something that Ray Dalio refers to as the holy grail of investing. He obviously uses the term a little bit loosely. But when you hold different assets in a portfolio that are uncorrelated, i.e. they don't respond to the same things, right? So as we spoke about there, stocks and bonds, they don't normally correlate and do the same thing at the same time. When you have assets that aren't correlated, you're able to massively reduce your risk in a portfolio. So if we look here, for example, if we look across the bottom axis there, you'll see number of assets, right? Or what he refers to as alpha. So number of assets. So obviously going from 1 to 20. We have the left-hand side, we've got standard deviation. That's the volatility of a portfolio. And up the right-hand side, then you've got return to risk ratio, right? Now, what you'll notice is that the more assets you have and the less correlated they are, so the less correlated would be the lines that come down, the lower the volatility becomes on the left-hand side, and the higher the number becomes, because the numbers are higher towards the bottom there, that your return to risk ratio is. The probability then of losing money in any given year becomes much lower, right? So you can actually build portfolios where you don't have to necessarily predict the economic condition. What you can do is you can say, well, what I'm going to do is I'm going to hold some uncorrelated assets in my portfolio. This would be more of like a retirement portfolio, right? Or what Ray Dalio refers to as an all-weather portfolio. I'm going to basically evenly balance my portfolio, distribute evenly across different assets and how much of each I hold. They're not correlated, so now my risk massively comes down. The chance of me losing money in any one year becomes lower, and the volatility of my portfolio becomes less. And now what I'm doing is I'm building a low risk portfolio. So this is where you then sit there and say, well, let's imagine you was at a stage, or just your preference was that you wanted to have an investment portfolio that wasn't so much aimed at growth, but was a little bit more aimed at capital preservation and just very slow, steady gains. You might be somebody that's more diversified in your investment portfolio, right? You might be somebody that goes, you know what, I just want to be focusing on growth. So then what you're going to be doing is you're going to be focusing on this and saying, right, where can I get the most growth in my portfolio? Right? If I believe we're in an environment where we're going to have economic expansion, inflation isn't out of control, I want to be focused on stocks. That's where most of my portfolio is going to be. If we were sitting there saying, well, I think we're going to be in an inflationary environment, I'm going to reduce my exposure elsewhere, increase my exposure to commodities. But if you were somebody that wasn't looking so much for growth, but more capital preservation, you might then sit there and say, well, what I'm going to do and what my preference is to diversify a little bit because I'm looking to reduce the risk. Your day trading might be your sort of income, if you will, trading wise, right? That might be your bread and butter in terms of making money. And then what you're doing is you're diversifying the profits that you've made there and putting in a very low risk investment portfolio where you're split now between uncorrelated assets, stocks, bonds, commodities, etc. And what you're now doing is you're building a low risk portfolio that just steadily trudges along and makes you a healthy return, but isn't as growth orientated, right? So I'll give you an example. Ray Dalio's all-weather portfolio that he builds, okay, over the last 70 odd years has averaged about 8% per year, okay? Compare that to the S&P 500. The S&P's averaged around about 9 to 9.5%, including dividends. So you're about 1% less in terms of average, annual performance. However, if you look at the deviation of that portfolio and the big drawdowns and stuff like that, an all-weather portfolio has less than half of the volatility. So you've only given up 1% of upside, but you've reduced your volatility and risk by more than half. That might be something that is a preference of yours. Okay. Now, I'll just stop it there for a second. Austin, if you're still with us, can I just double check, guys? Has that made sense to everybody? I just want to kind of, sort of make sure everyone's still kind of keeping up with me. Just pop me a message, pop something into the chat there. Just give me a yes or no before I move on, just so I know that everyone's kind of keeping up with me. Let me know if there's anything you need me to reiterate or anything. We'll go through bigger questions at the end, but just for the time being, just give me a yes or no if that's making sense, guys. I can't actually see the chat this side, Austin, so just let me know what the guys are saying.
Yeah. So far, yes, I love this. Yep. So I think so far I'm following you. So if I'm following you, that means they should be following you too. Question for you though, could be good time to ask this. What are some of the mistakes? You don't have to answer it right now. You can spin this in, but what are some of the mistakes people make when they are trying to build this portfolio? Because it seems like the way you're describing it, there is a clear framework that Dalio, Buffett, some of these guys who are traditional investors, more longer term guys that have built a reputation over this. What are some of the mistakes that they didn't make that someone like you or me normally makes? Is it that they aren't breaking into that quadrant, like they aren't understanding where in the quadrant they are? You know what I mean? Is that a fair question?
Yeah, that makes perfect sense. And I think where a lot of people go wrong is they don't have a clear goal in mind, right? Because it's not a case, you don't kind of just dive straight in and go, right, where am I best to invest? It's a case of you've got to sit there and say, right, first of all, what is my personal mandate here in terms of what is my goal for this investment portfolio, right? So if this investment portfolio is being built as another way to focus on growth, well, now I know that I need to be more focused on the areas that have growth potential, and I'm going to be more concentrated when building this portfolio,
Sure.
i.e., which quadrant are we more likely to be in, and what asset class am I focusing on most of my attention on, right?
Yeah.
If you're somebody that's a little bit more, okay, this is an investment portfolio that's nice and low risk. For example, I'm day trading over here. That's kind of my bread and butter in terms of my growth, right? But then I want this to be nice, low risk. Well, then it's not so much about, okay, what quadrant am I in, but am I evenly distributing my risk across these quadrants so I'm not having to now work out what economic condition I'm in? Am I managing my risk and exposure? So I think the first question you've always got to ask yourself is, what is the purpose of this investment portfolio? And then from there, you can kind of say, right, now this is the framework I need to use to achieve this. Does that make
Makes sense.
sense?
Yeah, 100%. It's a good
Yeah.
answer. All the
Perfect.
chat is saying, yes, yes, this is very good. I'm going to have to rewatch this and take some notes. So I think we'll hold off on a couple of the other questions until the end. If that's
Yeah.
okay. Yeah.
Awesome.
All
Perfect.
right.
Just wanted to double check everyone was keeping up. That's awesome. Thank you, Austin. Thank you very much. Right. So, what I want to do with you now, guys, is just kind of explain to you because you may well have heard, and don't worry if some of these charts look big and scary, right? I'm going to explain kind of what this is and what we're looking at. Um, but I think where a lot of people go wrong, you may well have heard this saying, right? People say the stock market isn't the economy. People have probably heard that, right? People go, oh, the stock market isn't the economy. And of course, they're not perfectly interlinked. No two things are perfectly 100% correlated. It just doesn't exist, right? But whenever there is a positive correlation, you need to be paying attention to that because if there is a positive correlation, that basically means that something is going to happen more often than it isn't. So I need to be focusing on that. But also, I need to understand what happens when things are uncorrelated and the effects that it could have. So, what I'm going to be speaking about for the next few minutes is more so a case of if you were somebody that was looking to build an investment portfolio for growth, not so much just low risk. Okay. So, if you're building a portfolio for growth, the majority of the time your attention is going to be focused on stocks because like we said a minute ago, general rule of thumb is what you're wanting is an environment and which is more present than not where the economy is nice and positive, the economy is growing, and therefore stocks is your best performing asset class. So if I'm looking for growth, that's the environment I want to be in, and that's where my focus is, right? Now, how do we measure, or what is the general measure of how well an economy is doing? Well, we look at GDPs, that's gross domestic product, right? And that basically tells us, is the US economy, or just an economy, because obviously you get GDP in other places, right? But is the US economy in this scenario expanding or is it contracting? So if it's positive, the economy is obviously expanding, and if it's negative, the economy is obviously contracting, right? So for example, we've actually got GDP data coming out tomorrow, right? So that will tell us the last quarter, has it been an expansive state for the economy or have we actually contracted within the economy, right? Now, don't so worry so much if this chart looks confusing because what I want you to do is focus your attention here. Let me just zoom in so back, just make sure everyone can see these numbers here, okay? So what I've got is a couple of different columns. I'm going to go through each one. So column one is correlated, so i.e., this is how much of the time GDP and the S&P do exactly the same thing, i.e. GDP goes up, S&P goes up. GDP goes down, S&P goes down, right? How often do they do exactly the same thing? What percentage of the time are they uncorrelated, i.e. one goes up, one goes down? But also then, what is happening during that? Okay, so when we are uncorrelated, well, what is happening more often than not? So let's first of all look at just purely correlated and uncorrelated on the left-hand side. So out of the last 213 quarters, so this is going back around about 53 years, okay? 68.08% of the time, so almost 70% of the time, GDP and the S&P 500 do exactly the same thing. They both go up, they both go down together. Okay, they do exactly the same thing. So basically, 7 times out of 10, wherever one goes, the other one's going to follow. That means obviously just over 30% of the time, they don't follow each other. Okay. Now, where it gets interesting is the uncorrelated occurrences. There's actually one thing that happens a lot more than the other. And this makes it a little bit easier to then actually pick a market direction. Because out of the times where they are uncorrelated, 80.88% of the time, that's been where GDP has gone up, i.e. the economy has expanded, but the S&P 500 has actually fallen. Okay. So more often than not, if they don't do the same thing, it's normally GDP going up and the S&P falling. Out of all 213 quarters that we have over the last 50 plus years, only 7% of the time has it ever happened, so only 15 occurrences where GDP has fallen, i.e. the economy has gone down, and the S&P 500 has risen during that time. Okay. So what does that mean to us as portfolio managers? Well, firstly, we're typically going to go with whatever direction we think the economy is going. That's our bias for stocks, right? If we think the economy is likely to expand and going to be positive, well, I want to be long stocks. To put it easy, nice and easy, right? If I think the economy is going up, if the economy is expanding, I think the stock market is going to go up. If I think the stock market is the economy is more likely to contract, well, then I want to be more reducing my exposure to stocks, right? This might be where we diversify into bonds or something like that. If we feel like we're going into one of those other quadrants, that's when we might then diversify away, maybe into bonds, or we might go into gold or commodities or something like that. That's the first thing. But what we also then want to pay attention to, if we are in a situation where we believe that GDP is going to go up and where we are expanding, we want to pay attention to times where the S&P 500 gets overvalued or overextended, because we know that when it isn't correlated, 80% of the currencies are going to be the GDP is rising and the S&P is going to fall. Okay. So keeping that in mind, that basically gives us this as a little summary down here. Okay. So the data shows us that GDP and S&P 500 returns have a positive correlation. As we've just said, that 70% of the time they do the same thing, right? Now, times when they are not correlated has mainly come when GDP has been positive, but the S&P 500 is extended and forms a correction. Okay. This is important to make sure we're kind of noting this just for our own future reference, but also so you can understand how I'm currently structuring my investment portfolio, which I'm going to show you in a minute. Okay. So basically, the data helps us form the following views when it comes to an investment portfolio, at least when we're talking about a stock-focused investment portfolio predominantly, okay? So if GDP is positive, we probably want to be 100% long stocks. If GDP is negative, we're either going to want to be neutral, maybe net short. If you only trade stocks, if you're someone that diversifies, you're going to be looking, maybe we're going into an area where one of the other quadrants is going to do better, and we want to diversify away from stocks. If GDP is positive, but the S&P 500 is extended, then we might look at having a small hedge in there or some sort of diversification to protect us in case the S&P now does have a corrective stage. Because remember, if we can identify times when we have correlation and GDP and S&P 500 divergence in terms of S&P falling, theoretically, you're never going to get it right all the time. But theoretically, if you did, you're going to get your direction correct 93% of the time. You're obviously not going to get it right every single time, right? But you start to, even if you get anywhere near that, if you get 70, 80% of the time your direction right, you're going to be, your portfolio is going to be structured very, very well. And the biggest thing with all of this, and the biggest reason why we do all of this, is because we're looking for risk-adjusted returns. When you are managing a portfolio, it's not just YOLOing into GameStop and things like that, right? We're building a portfolio to build wealth. This is wealth that we're looking to accumulate from its own accord, but also to compound as we then have our day trading profits and stuff like that and keep building that investment portfolio in that pot. Okay. So what we want to be able to do is have an understanding of where the economy is going. That's going to give us a good idea of where the S&P is going. And then we're just noting down, if we also think the economy is going up, but the S&P is looking a bit extended, maybe it's not one of those times where I completely follow GDP. And what I'm actually going to do is I'm going to start to hedge out or diversify a little bit of risk here. Okay. So there are ways that we can predict, for lack of a better wording, or have a good understanding of where the economy is going to go, because there's certain data that is actually leading to GDP. Okay, so there's certain data such as ISM manufacturing, ISM services, consumer sentiment, builder permits, and small business optimism Don't worry about, we're going to do other webinars later on and stuff like that to go through these all individually, okay? So keep in mind that this is a bit of an overview, but there's certain data sets that we can look at that gives us a good idea where GDP is going to go. And if we're in front of GDP, well, then theoretically, we're in front of the S&P 500, okay? So to keep things as simple as possible, I don't want to kind of overwhelm people, okay? So don't worry too much about how I've come to this conclusion, but just think of it nice and simply for now. Going to zoom in on what I refer to as my macro scorecard, okay? For simplicity, when it's green, expectation is for GDP to be positive. When it goes red, there is a risk that we're either going to get slow GDP or contracting GDP. Okay, so you can see we went negative here in 2022. We obviously had a couple of quarters of negative GDP in 2022, barring one very standout quarter last year. We've had then quite sluggish GDP in that it's been like a 0.5%, 0.4%, things like that, right? And we've been sitting in this red area for a little while. Now, because of that, I'm looking at the moment where, okay, we might not be in the ideal quadrant for stocks, right? If we just kind of remind ourselves here, what is the ideal quadrant for stocks? It's nice, rising, growing, expanding economy, i.e., positive GDP. But if I think there's a potential risk to that, well, being 100% long stocks could be a risk, right? And as we just spoke about over here, when we compare the two, we know that they do the same thing most of the time. Okay, so that's the first reason why I'm a little bit wary at the moment. I'm not sitting there panicking and saying stock market's going to crash or anything like that, right? But what I'm saying is that there are some potential underlying risks from an economic situation where we could at least see a slowdown in stocks, right? I never ever sit there and try calling a top in markets. I never sit there and say the stock market's going to crash, but I'm very aware that we could well see a slowdown in the stock market, okay? There is another factor as well. If we have a little look at the S&P 500, we've had a very, very large run higher recently. Okay, if I put this on a candlestick chart, for example, what did we say earlier on, and what do we know to be the average S&P 500 return? About 9% a year, right? Well, since the October lows last year to current price, we are up more than double that. And we've done so in a way that has not had a single pullback along the way. So I'm looking at a potentially extended stock market. Okay. Well, what is one of our scenarios here? GDP could still go up, but if the S&P is extended, then it could be that dislocation, and that happens 80% of the time when we're not correlated. So my personal portfolio at the moment is structured in a way, my stock portfolio, where I have what I refer to as what we call a hedge, okay, to basically reduce long exposure. And I'll just kind of show you what that looks like. So if I show you my portfolio at the moment, this is my stock portfolio, okay? So I've got Meta, Microsoft, Google, Visa, MasterCard, McDonald's, Coca-Cola, Hershey's, companies you're probably all familiar with, companies that I want to own. But then I have this ETF down the bottom here, which is SH, okay? Some of you may be familiar with it. But SH is an inverse S&P 500 ETF. What this basically means is I am basically short the S&P 500 there, okay? It's the reason I'm holding this ETF is the cheapest way for me to structure the trade through this broker. I don't get commissions and stuff like that, okay? But I don't think you guys can use eToro in America, so it's just a UK thing. But I'm just using this as an example, right? But you can see here value, this column here, value. Down the bottom, it's almost 30%. Okay, so basically what that means is about 70% of my portfolio is long stocks, but I've got a hedge in place where I'm short the S&P 500, the equivalent of about 30% of my portfolio. And what that means is instead of being 100% long and now exposed to a potential big correction in the S&P, or if the economy now does start to contract, like there is a potential risk from when we look at this, when we know then in that case, stocks definitely, or not definitely, I shouldn't say that, have a high probability of correction at that point, I'm sitting here saying, well, if I'm 100% long up here, that's risky. Okay. So what I'm doing is I'm reducing my risk by being short 30%. So I'm net long in my portfolio because I'm more long than I am short. Okay. But I'm not as long as I would be because It doesn't work out exactly like this because of the volatility, but for simplicity, in this example, if I'm long 70% but short 30%, I'm net long 40%. Does that make sense? 70 minus your 30, I'm net long 40. So I still make money when the market goes up. So if I look at my results this year, for example, we've still made money so far this year, up 1.8%. But if now the market does fall, I don't lose as much. Because remember, this is a portfolio. This is an investment portfolio, right? And I'm not looking to have big risk in my investment portfolio. I do have other portfolios that are multi-asset and stuff like that. But just because this is a stock portfolio doesn't mean that I'm going to be 100% long stocks. Because depending on what's going on over here, I'm going to depend on how aggressive I want to be towards stocks. Do I want to be aggressively long stocks, or do I want to be a little bit more defensive in my stocks? The goal is not to have the biggest up years all the time, because if I'm constantly aggressive like that, you end up with a Cathie Wood and an ARC situation where when they're wrong, they end up down like 70%. Okay. That now just hemorrhages money and is going to take 10 to 15 years to get back to break even. We want to avoid that. You're never going to avoid drawdowns. You're never going to avoid negative years. But what you have to remember is if you're focused on stocks and you hold individual stocks, they are naturally going to be more volatile than the index. What that generally means, for simplicity, is if you was just to hold an S&P 500 ETF, for example, or you held, say, 10 stocks in a portfolio, those 10 stocks are going to move up and down more. That's good in a year when you're positive because you could outperform the S&P, but in a down year, you're probably going to underperform. So what I'm trying to do here is I'm trying to identify times where being 100% long stocks is risky because if the market does fall, I don't want to lose more than the market. My ideal scenario is obviously to outperform on the way up, but if I can keep pace with the S&P on the way up, but then lose less on the way down, I make more money long term. I have a much smoother equity curve and I end up much less stressed, right? Because I'm identifying when we're not in the perfect scenario. Does that make sense to everybody? Hopefully everyone's kept up with that. I hope that makes sense. Give me a little yes or no. Austin, if you could let me know what the
Yep.
guys are saying there, if that makes sense.
So far, we have a couple more questions I want to get to in a few minutes, but I think let's see what they say. But I'm following, so I think they are as well. When you're looking at the overall macro picture, yeah, some people are already
Hmm.
saying, yeah, they're following. When you're looking at the bigger picture, when you think about the short percentage of your portfolio, how do you determine when you go 50% short? Do you ever go, is there a max on the short percentage that you would ever want to be?
That's a good question. So that really and truly depends on kind of my view on things, right? So because at the moment I'm sitting there, so my personal view is I think there's economic strain and we could get a slowdown in the economy and the S&P looks extended to me, I'm going to be slightly more short, more hedged, right? i.e. 30%. Now, if we was to see, let's just create a scenario here. Let's imagine the S&P completely changed its trend. It went bearish. The macro picture got worse, etc. I'm going to increase that hedge, right? That hedge is going to get bigger. Now, the reality is, whilst I think there's risk, the market is still technically positive. It is still trending in a positive direction. So I still want to be net long. I still want to be net long in the portfolio. I'm just taking a little bit of risk off. Now, let's imagine it was a scenario where the S&P wasn't extended. It was very, it pulled back nice and sensibly, and it looked very kind of textbook technically sound, if you want to call it that. But I thought there was a little bit of macro strain or potential risk. I might only be 10 or 20% hedged, right? So it really kind of comes down. There's not like a set quantitative way of doing it per se. But at the moment, because I think there's a couple of risks, but we are still positive, I want to remain net long, but I want to be a little bit more defensive than if it was only one risk. Does that make sense? Have I explained that properly?
100%.
Yeah.
Yep. And
So
so, and what everybody is saying in the chat is they're following you so far. There are a couple of questions, but like I said, we'll come back to them.
yeah, we'll get to the questions in a second because that's pretty much wrapped up. But the obviously, guys, me and Austin are talking about doing more things like this and getting into more specifics. And the purpose of this evening is to kind of give you an overview on the sort of things that you need to focus on to be able to build a portfolio, right? But To give a kind of summary, if you will, the first objective for you is always to work out what is the goal of my investment portfolio. Obviously, yes, we want it to make money, but is it growth orientated? Is it very much to be low risk and diversified, right? What do I think and what is my mandate within this investment portfolio? From there, it's a case of, okay, right, now what is my view of the economy? That's the first thing because I'm working out where are the potential risks? What quadrant am I in here, right? What sort of environment am I potentially going into? From there, you can then determine what sort of portfolio you want to build, right? Where am I seeing the risks? Where do I think the potential rewards are? And it's like a step-by-step process working down from the top like that. Now, it might sound like a lot if this is new to you, right? But to give you an idea, obviously things like GDP comes out once a quarter. Things like ISM comes out once a month, right? So although it looks like I've got a lot going on here, because it's just tracking data from years and years ago, it literally takes me like, I would say as a combination, less than an hour a month to update my Excel sheets that I'm actually doing, right? So if you was running anything like this alongside a portfolio, a day trading, a strategy and stuff like that, it isn't going to take up much of your time. It's more just a case of having the knowledge set of kind of how to put it together, and then you're just ever so slightly tweaking it and keeping on top of it, as opposed to you're sitting there having to monitor it every day. So hopefully that helps, guys. I think we're going to open up some questions and stuff like that now. But yeah, hopefully that helps and gives you a little bit more insight into portfolio management and kind of how you would go about it, basically.
I loved it, Ben. This was great. A lot of good information. Definitely a lot more to dive into, which is why this was a great intro to just kind of set the stage for everybody and get some people excited about this. Because I think if I go back to when I started day trading almost 10 years ago, if I would have invested in some learning in this stuff then, I would probably have I definitely would have a lot more money in investments just working for me than I do now. You know what I mean? So I think for a lot of these guys, younger than me, same age as me, older than me, like it doesn't matter. It's just like if the key here, and I don't know if you maybe said this enough, it's time in the game. It's not right. That is the big thing here. It's like accumulating more, letting it compound, using that leverage, so to speak, without leverage, but like using the power of compounding and money in the market.
Absolutely, absolutely. And what you're basically doing then is you're starting to compound and build your wealth in various ways, right? So if you're on holiday for 2 weeks or you go traveling for a little bit or something like that, you've got your money compounding and working for you over here, right? When you're sitting there and you're day trading, you've got a hot market, that's going to obviously make you more money, right? So you're compounding your money over here.
Right.
The idea is that you've got more levers to basically be able to pull on and be able to have more ways of compounding and generating your wealth. And as we know, compounding is the thing that's going to get you to that end goal so much quicker. So if you've got numerous skill sets that you can pull on, and maybe then other income sources on top of that and all this kind of stuff, things can compound real quick and get real big real fast. So it's about having more strings to your bow, if you will, and being able to compound and pull on those levers as much as possible. Yeah, 100%.
What's interesting to me, and then we'll go into these questions, is number one, how not sexy and simple this is, like you said in the beginning. It really is. But also, it probably has shown you over the years how these markets are built to go up. U.S. markets specifically, would you agree, are built to go higher? They attract more inflows than we see outflows still.
Oh, 100%.
Yeah.
100%. It's the nature of the beast, right? You're the biggest, most progressive economy and country on the planet. GDP that far outweighs anything else. People talk about China and all the rest of it. It's still a long way behind kind of where the US is. That's just the reality of the situation, right? Whether that's the case in 50, 60 years, who knows? But, we're a long way off of that. So therefore, it always attracts the most money. I mean, you've only got a great example, obviously, me being based in the UK. Lots of companies from here, when they want to go public, they go over to America. They go to go public on the NASDAQ or the New York Stock Exchange. It is the place to go, right, for capitalism, basically, right? So the nature of the beast is the economy is designed to keep growing and expanding. That then leads to companies and everything wanting to be there. It's just everything. That combination is just there to grow and build wealth. And then you as an individual, if you know how to position yourself within that, whether it be day trading, portfolio management, whatever it is, you can then take advantage of that situation. But as you said, it is designed to grow. That is just the way that it is, right? So, if you understand that and kind of use that to your advantage, well, then you can, make a pretty penny off of it over time.
That's it. All right, let me hit you with some of these questions.
Let's go for it.
Some might be a little quicker than others. Someone asked, how do you determine when the S&P is overextended? Is there a metric? Is there an indicator?
So for me, I like to keep it from a technical aspect quite simple. I like to be very price action focused. So, if we just kind of look at a visual aspect, right? If we look at the stretch up that we've had here, more recently, we've had this big stretch up. Well, the only other time really we've had a run like that at any other time over the last couple of years would have been here. And then look what happened. We had this big correction, right? Naturally, markets rise and fall. They have corrections. Your textbook trend would be, move up, move down, move up, move down, higher highs, higher lows, right? When we've got a market that just keeps going higher, 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 you're going to get exhausted eventually with your buyers, right? So we look at it a lot when we look at technical analysis. You get what a lot of people refer to as your mean reversion. You have these big extended moves that naturally now have to unwind because there's no more buyers or no more sellers left to be driving that market.
Sure.
And naturally, markets have to balance themselves. So for me, I'm looking very technically from a price action perspective rather than any indicators because I don't like to lean on indicators too much. An RSI, for example, could reach 70 and the market could go up for another 3 months before it turns.
We all know that, right?
Yeah, I like to focus on the price action element.
When you see overextension happen, and maybe your answer can be, we can look at this later in another webinar, but do we need to do another webinar maybe about how to get out of these positions and then where to move the cash when you're saying, hey, we're up X amount, 20, 30% from our initial position on whatever, let's say in Visa, and we know that the market is overextended right now. Visa could potentially pull back 20%. Will you sell out of that position, or what? Do we need to talk about this in a different webinar? Is that?
Yeah, I mean, I'll answer it briefly, but we can definitely do another webinar on it because obviously there's a few different ways you can do it, right? But I'll never completely sell out of an idea that I still want to have.
Okay.
Because let's just create an example. Imagine I'm long Google. Google rallies up 50%. Well, if I now just completely close out, when I've got to buy in at a higher price,
Correct.
My average price is becoming higher and higher if I sell out, buy in altogether. What I might choose to do is because naturally, if something has run massively in your portfolio, it's going to be a bigger weighting in your portfolio now, right?
Sure.
So an easy way of doing it might be rebalancing it with other things that you already hold. So you might partly reduce that position, which now reduces your exposure to it. It rebalances everything else in line with what else you're holding. So now if it does pull back 20%, you've got other things there to kind of hold your portfolio up.
No, that's a good answer. And we can definitely go into some examples of that because there's definitely a few different strategies that can be applied for that. So that's good.
Absolutely.
Would you ever decide, and if so, when would you get out of the 30% short position? Would you ever be 100% long?
I would be 100% long. Yes, I was 100% long back in March, for example, before we had this big run up here. I actually then had 2 hedges on earlier this year. I'd say more luck than judgment because I don't think anyone can perfectly call tops, right? But I was hedged short in here. So I managed to, reduce some of my downside. I actually then re-hedged a bit lower here when we started to break down. I thought maybe the market was, having a bigger correction. But then once we rallied and broke into new highs again, I removed the hedge altogether, was 100% long once more until more recently when we got extended again. So it's more there as a safety blanket, yeah. But if I feel necessary, I will 100% be 100% long stocks, yeah.
It's super cool that we can talk about being short the market now because like back in the day, if you wanted to short the market, even 50 years ago, it was very difficult to get short. And if you were an average retail investor, you know what I mean? This is still
almost impossible as a retail investor, yeah. Yep. It was almost impossible, yeah.
One of my guys, Ryan, said, this is some big brain Warren Buffett shit going on. That's funny.
I'll take that as a compliment.
Definitely
Hopefully
a compliment.
I don't look like him. I know I'm getting older now, but I don't think the wrinkles
Dude,
are that
funny.
bad.
In that picture of you in the beginning, I feel like you look a little older in that photo of you in the beginning of the slideshow than you do right now. So you're reverse.
Maybe I need a new picture.
Carlos said some of the best long-term investment data I've ever seen, so that's good. It's a little complicated for me as a beginner, but that's okay, Pranav. We're gonna work on that, bro. We're gonna get it firing. All right, I got a couple more. Do you touch your stocks in your portfolio at these all-time highs, or do you take some off to risk? Yep, basically we just answered that. Risk based your current markets. Yep, okay. Would love more info and webinars with Ben. This type of stuff should have been taught in schools. Totally agree. Someone else agrees. Question for later: Is he constantly hedged 100% of the time with longs and shorts? No. So sometimes he said, Brent, he will be 100% long. You're never 100% short, are you, Ben?
No,
because that would mean you'd have to sell initial positions on all of these good stocks.
Expand. Right. Yeah, exactly. It's just a case if it gets real risky, I want to take that risk off the table.
Which makes sense. Yep, 100%. Let's see. When you pick the stock, how you calculate the sum of the potential returns, longs versus the short side of the portfolio, to know you got a positive return at the end of the year. You follow that question?
Yeah, I think so. So when I'm picking individual names, I don't normally set a target per se. My idea is that I will always hold a position all the time that the investment thesis still makes sense. So, for example, if I buy Google a year ago, and I'm still holding it today, the question essentially is, if I didn't already hold it, would I buy it today?
Yeah,
If the answer is no, because there's something wrong with it, well, then I probably shouldn't hold it and I should get rid of it. If the answer is still yes, well, I'm going to continue to hold it. So all the time it makes sense to hold, I'm going to hold it. So whether that ends up a month or 4 years, all the time it's making me money and it's a good investment, I'm going to keep holding it.
two more. How long does it take you to come up with the investment thesis?
If we're talking about the macroeconomic, idea in terms of how I want to structure the portfolio, like I say, that really doesn't take long at all. It's more just keeping an idea on the trend. So like I say, I probably spend less than an hour a month in
Okay,
terms of keeping up to date with that, right? If we're talking about the individual investments, then obviously they take a little bit longer.
sure.
You might, a whole idea from start to finish might take an hour because you're going to do a little bit of extra digging and research and stuff. It will obviously vary person to person, like anything, but yeah, it all just depends on the individual, really, I guess, in that sense.
Sure. Year over year, are you changing what stocks are in the portfolio based on GDP and what you think will be performing well?
Not necessarily on, to do with GDP, but I am conscious, sorry, of the sort of exposure that certain industries have. So, if we have a company like McDonald's, for example, people aren't going to stop buying hamburgers tomorrow if we're in a recession, right? The same as people aren't going to stop buying $1 cans of Coke or whatever because we're in a recession.
It's
So
true.
those sorts of companies are going to do fine. But there might be other businesses and other industries. Let's imagine we had a big recession and stuff like that. Home builders, stocks like that,
For
they're
sure.
probably not going to do so well because that's
Right.
not a good environment for that. So you're obviously paying attention to that, but I wouldn't do it just based on that. I'm kind of conscious of it, and it all kind of comes as part of the process because obviously, as you're doing your analysis, if you think there's a recession coming, you're not even going to be looking at home builders to start with. So,
No, definitely not. When do you get out of your short, like from a profit perspective or from a stop perspective? I would guess from what you said, it's based on technicals when the market has then moved into a strong upward trend, like where you were pointing at the breakout for highs. Like that would be when you take the
yeah,
short off.
Yeah, so let's just create a scenario. Imagine we had a healthy pullback and then the market started to kind of move higher again. It looked better technically and there wasn't too many risks on the macro side. I might reduce that hedge.
Just
The idea of a hedge, and
yeah,
in the ideal world, I
yeah,
always try and explain it to people, you want your hedge to lose money.
right.
Your hedge is there to protect you if the rest of the ideas don't play out, right? So it's more there as a safety blanket than anything.
When you sell the short, do you incur a short-term capital gains tax? I mean, if it's a loss, you can write off some of it, of course. But do you know in
Yeah,
the
if it's a loss, you can write off. Yeah, I mean, obviously, it's going to depend on where people are based, and
right?
it's all going to come in with
Do you
the
guys
rest
have
of
that
your
in the
portfolio
UK? Like a
performance.
difference between short-term gains and long-term gains? Do you have a separation?
There can be depending on also how else you're earning money and stuff like that.
Sure.
It can get a little bit complicated,
Yeah.
as it probably does in the US as well.
Yep.
Um,
But if what
yeah,
I'm
it
saying is,
depends on
if
how
you put
you're
the
earning it.
if you put the short on in let's say January, and then you take the short off in April, that's going to be a
Mm.
short-term capital gain if the short made money. If
Yes.
the short lost money,
Yeah.
like it's supposed to, you would have that to write off. I mean, in the U.S. right now, I think it's like 3K a year you can write off. That's it. But if you lose 6K
Yeah.
in
Exactly.
1 year, you can write off 3K this year, 3K next, something like that, right? And of
Yeah.
course,
Exactly that.
there's other things around that, but that's for another
Yeah.
conversation. We'll have to bring an accountant in for that. Let's do a few more. Tom's hitting with some questions here. Yes, what Tom said. Okay, let's do. I like this one because it's a quick one. What is your end goal? Do you have an edge or an age at which you look to take your money out of your portfolios? I'm going to guess your answer is no, because if you build up
No.
enough in the portfolio, you can take loans against the portfolio. You have dividend funds that can pay cash. A lot of these stocks pay cash and dividends. So
Yeah.
you just want as much money in the portfolio as possible until you die, and then
Yeah.
you pass it on, right?
Yeah, exactly that. And it'll probably be more a case of the focus of the portfolio would change. So
Sure,
it'd be less growth and
sure.
more all weather style, split out and diversified focus, like we spoke about earlier on. So the mandate would change as opposed to wanting to invest changing, if that makes sense.
Yep. Jason's making people. Jason's like the write off is a joke. Yeah, I know. 3K. That's all they let you write off. All right, let's do just Tom's two questions and then we'll wrap up. You clearly like data. How much of this drives your investing decisions versus the discretion from a fundamental perspective?
Oh, good question. I would say it's probably maybe 75% data driven. That's going to kind of arrive me at a destination. And then the qualitative sort of checks, etc., is going to be obviously, okay, does the story match the data
That's
kind of
good. So
thing?
it's
So,
both.
yeah, it's definitely both, but I would say it's more data than
Than
more because
discretion.
that kind of gets me to the decision.
Which fits
Yeah.
in perfectly again with what we do because we do so much discretion in the day trading where you can have a little more feel and whereas this
Certainly.
is
But numbers don't lie, right? So your
yep,
edge is your edge. You know what your statistics are off of certain things and consecutive days and stuff like that. So, you're always linking it back to that, I would imagine, right?
100%.
There we go.
Is there any basic advice you could give to data lovers on where to potentially start as if you were a beginner again? Like I guess Tom is saying any data specifically to study about stocks or funds that would be good. Do you have any direction on that? And that's part of what
Um,
Ben talks about in his course actually too, Tom, is like some of the metrics to
yeah.
study and to look at.
Yeah, I think it'd probably be too much of a long-winded answer. So I think that'll probably be maybe something that we
All
kind
right,
of
we're
get
gonna
into
table it.
other
We'll table
webinars.
it, Tom. That'll be for the next
Yeah, we'll get
presentation.
into some other
So
webinars. We'll be here all evening.
yeah, exactly. So what we're doing, everybody, just to give everybody a heads up, my plan with Ben is we are going to be putting out a course probably in March. So between now and March, to get everybody excited for what is going to be shared in the course, I've seen it. Ben had me watch the whole thing, and I've basically seen it, the entirety of it. We're actually going to together re-record some of it. It's going to be really great. It's going to be like an updated version with some other ideas of even like questions I had for Ben that he can elaborate more on. That's going to come. So between now and that course dropping, we're going to have Ben come on at least one or two more times, maybe even more, just depending on the feedback that I get from this recording and everything. But it seems like everybody that was here live is really interested, which is part of the reason why I want to keep doing this. Jason said, really appreciate it, Ben. It provided me a perspective that isn't what we normally are exposed to as day traders. Thank you for providing this, Austin and Ben. This is a well-rounded investor education for sure. Carlos said, do you include quant screening? Do you know what that is?
Yeah. So it's basically data screening. So
Okay.
I'm looking at certain valuation metrics, etc. Yeah, so that's exactly what I do at one of my stages, mate.
Cool.
Yeah.
Yep. Good. So as we are working in the back end, we need to hear from you guys. Whether you're here live and you want to message me on Discord or an email, my email address is info@asfx.biz. Please shoot me an email, shoot me a Discord message. I would love to hear questions, feedback, positives, negatives, really anything of what we want to get out of Ben for next time. But my plan is, as you can tell, do these little presentations on ASFX TV, kind of drop a couple of crumbs to get everybody excited for the course. And then we already talked about it. We're going to offer you guys a big discount to get everybody excited, get everybody into that information. Because it is something, and this is what everybody is saying, like, you really want to rewatch this stuff. It's not something that you normally get the first time. And sometimes you'll have questions. So along with the course, we're going to actually create a subsection in our Discord where Ben will be able to interact and answer any questions that you guys have. Similar to what we do with Jerome and his backtesting course, as some of you guys may know, we'll do the same thing with Ben. So that way, after the course, if you're like, hey, I'm looking at this, am I doing it correctly? Ben and I will both be there to give some guidance on that. So a lot of exciting things to come. Luke said, nice, I can't wait for the course to come to us. And thank you for your time this evening. Yeah, absolutely, Luke. Thank you. Mary on Hell said, awesome. Who's that? Mary Angel? Nice. I like that name. Awesome. Carlos said, thank you. This is great. Pranav. Good. We had just about 30 on here live with us, which is exactly what I was expecting, Ben. So the numbers were good.
Awesome.
This was a good turnout. For everybody that stayed all the way through, seems like most people did. Thank you. Ben, thank you. This was great. Tom said,
pleasure.
thanks both.
Thanks for having
Appreciate
me.
your time putting this together. Robert said, great information. Looking forward to what's coming. So this is good. I want everybody to let me know. Give me some more feedback. Shoot me a message. I will be running my usual live stream on Friday. Evan will be running with you guys tomorrow morning. So let us know, I'll be there for Evan's stream as well. But I think for now, we can put a pin in it. Ben, can't thank you enough, brother. This has been great. I will
Pleasure,
circle
man.
up with
Thank
you.
for having me.
Yeah, absolutely. I'll circle up with you later this week once I get some analytics on this. We see the numbers on viewers in the replay and stuff like that. But this is really good stuff, bro. So I'm excited to really dive into this with you.
Awesome, my pleasure. Thanks very much for attending, guys. I'm glad you all enjoyed it, and yeah, make sure you give us some feedback, and that makes we know exactly what you need more of and stuff like that, and we can structure it in a way that best serves you. All right, so it's our absolute pleasure.
Awesome. All right, everybody. Rachel, Laura, Tony, Carlos, Pranav, Tom, Robert, everybody who's here live. Thank you for being here. I'll see you guys tomorrow, and until next time, see you, everybody.
Take care, guys.